right, good morning, everyone. Thanks for waking up early and joining the second annual Tech Talk at ILF. This is the second one we've done, and it's good to see some familiar faces and some new ones as well. For those who I've not had the opportunity to meet, my name is Rob Boyce. I am Director of the Market Intelligence and Insights team at CIAB, the council. And we've been monitoring this space for several years now, and wanted to provide a little glimpse into some of the companies that we have working relationships with from varying perspectives. A couple housekeeping items before we get started. So we'll have two panels. This first one is on alternative distribution models, as you can see. So we're hearing from 4 unique companies that have taken a non-traditional approach to distributing commercial insurance, often outside the retail space. And the second will be moderated by my colleague Cheryl Matochik. And that one is on a similar concept, but streamlining small business insurance and the strategic approach firms need to make when deciding whether to build something in-house, buy a white label solution, or partner with a third party. I wanted to go over one thing before we get started. We've incorporated this new platform called Slido into the panel this year. It's really easy to use, and it allows the panel to engage with the audience. So if you take out your phone, you can go to slido.com, and we're going to give you guys a couple minutes to get started. And what you can do is we're going to poll you guys 2 questions throughout this panel, and then the panel members are going to reflect on the answers. So when you log on, we're going to flip it over to Slido, but you can also ask questions throughout the panel that we'll give 10 or 12 minutes at the end of each panel to address. So we want you guys to be engaged. We ask, feel free to open it up, and we'll throughout the panel, and whenever we finish up our set questions, we'll move to you guys. So what we're going to do is I'm going to ask this question, and you should see it come up on your phone. If not, we'll figure it out. But the question is, what % of small business insurance do you think will be sold direct online by 2025? Is that showing up on everyone's phone? Okay, so what we're going to do is we're going to give you guys a couple minutes to answer that question, and I'm going to introduce the panelists, give them about 2 minutes to introduce themselves and talk about what makes their distribution model unique, and just get a little glimpse before we get started. So Sofya, we'll start with you.
Sure. Hi, everyone. Thank you for being here. I know we're competing with breakfast, so I appreciate everybody's time. I represent Next Insurance. I'm the Chief Operating Officer with the company. We are a 3-year-old insurtech startup focused on small commercial. And while we started as a distribution play, today we play across the value chain. We develop, design, file, build our own insurance products. We distribute. Our distribution channels are a mix of direct and retail. We also underwrite and rate in real time. We service the products, and we are also starting to adjudicate claims in-house. Excited to talk to you about the value prop that we believe we have for the retail, for the agent channel.
Thanks, Rob. Good morning. I'm Phil Edmundson, CEO of Corvus Insurance. And just reflect for a second that the 2 panels are almost interrelated. I'm excited not only to hear from my co-panelists here today, but the second one, because both of us have some play in this space. Corvus is a little more than 2 years old. We take new sets of data and we use them to predict and prevent commercial insurance claims, and we think that creates value for everyone. We've gone to market as an MGA because we think that having that information and utilizing it well will make us better underwriters, but we also use it to produce value-added differentiation for retail and wholesale insurance brokers. So we very much embrace the broker portal, the broker chain, but we're also interested, as everyone is in the panel, in other ways to use our data. So we are particularly focused in cyber insurance, and we think of cyber more as a peril than a product. And we think that there'll be a lot of opportunities and growth in areas, in commercial lines, in the engagement and understanding of the cyber risk.
Thanks. My name is Steve Hauck, Managing Director of AP Intego. We are a member of the council, and a little bit about AP Intego. We are a nationally licensed retail insurance agency, and we source our business through partners Most of our partners, or the majority of our business, come from partners who are software players that sell an ecosystem to the small business. And we source business from these partners and act as their agency fulfillment engine, similar to what Paychex and ADP have built on a proprietary basis. We provide entities that serve the small business a property and casualty small business fulfillment engine.
We are 100 years old, so quite a bit older than the rest of the folks from a company standpoint. And you know, I represent our emerging businesses group, and our focus is how do we reimagine what we've done for the past 100 years for the next 100 years. And we're specifically set up from an innovation and venture and partnership standpoint to think differently about our core businesses. And what's interesting is as we do that, we run into these folks. So my team specifically focuses on emerging partnerships with adjacent industry companies. So think about tech, retail, financial services, automotive, healthcare. And what's happening is with the level of connectivity and data and technology that's happening in the world around us, they're beginning to see insurance as an adjacent industry that they can begin to provide value, you know, monetize their data in a number of different things. And so what happens is as we're doing that, and we as a carrier go talk to these companies, we run into these folks because they're already there, engaged with them in a conversation about our industry. And so I believe there's a tremendous opportunity for carriers and insurtech and brokers and retail agents to all work together in this emerging distribution space.
Great, thanks so much, guys. So we're gonna give this a shot. We're gonna move over to Slido to look at the poll results. And I'm gonna give the four panelists an opportunity to digest these and reflect. And we'd love to hear kind of some, whether or not you're surprised or you have a different perspective. And then after that, we'll move on to some more formal questions. For those that just trickled in, if you look at the bottom of the next screen, slido.com, you can post questions throughout the panel. So feel free to post it and we'll reflect and answer those questions at the end. But Sofya, let's start with you.
Sure. The way I would read this is that half of us in the room believe that between 20 and 50% of small business insurance by premium or by policy number, we don't know, will be sold online in 5-6 years. I would say I'm in the same bucket. Okay. We believe that for a substantial and growing segment of the small business population, there is an opportunity to sell good product and provide good service and good advisory directly. And I think that segment will grow. However, there will always be, I think, a substantial segment of more complex risks, whether they're larger or less standard, that will prefer, rightly, to work with an advisor and will continue to see value in that. So I think I would commend the audience on a reasonable estimate here. I think this will turn out to be correct.
So I ditto on Sofya's comments, but also from the perspective of someone who ran a retail insurance brokerage business before Corvus, you know, this isn't all bad. For most of us in businesses that have a certain scale, it's been very challenging to serve smaller customers and have the economics work out. And that's part of the reason why there's been other successful efforts like Steve's and others to address that need. So I hope nobody looks at this as a bad thing. I think if it's serving customers, that's what's important.
Great, thanks, Phil.
I actually think it's actually not a great question. I think
That was my answer.
I think direct is very loosely defined, right. And everybody has a different definition of direct. I would say I could be an agent and source and sell a policy on a direct basis, right. But I could also be a carrier and sell it directly. So what I believe, and you could also say that you sold something direct, but it was an email correspondence back and forth with a call center at a carrier or an agent, and is that truly a direct transaction? What I believe is that there will be a higher majority, like greater than 50%, maybe less than 90%, that will have an agent assist in a small commercial transaction. in 2025. So I'm not as bullish. If your definition is of direct, not including an agent, I think an agent will be very much in the mix in small commercial, in the 75 to 80% range in 2025.
Yeah, I would agree that in 2025, I don't believe we'll be thinking in this way. It's sort of a industry-forward question. Direct has become a convenient way for the industry to talk about different channels, but I don't believe that small business owners think about channel. I think that they consider their insurance policy a lot less than they do the transactional and operational platforms that Steve is working with, like with operating platforms and accounting software and payroll and those sorts of things. And so I believe that by 2025, we will be asking ourselves a different question. Nationwide right now, for example, is building API capabilities for local independent agents to put an API on their homepage so that someone can get a quote all the way through with on a commercial policy and on a personal lines policy. And so, you'll have a local agent digitally binding policies on their website. And so I just think that by 2025, we'll be thinking of something very different, and I don't know what it'll be, but I believe that these three companies here are on the forefront of what that will be.
Great. Very helpful. Thanks. So we're going to go down the line for some more structured questions, but feel free to piggyback on anyone's answers. So Sofya, let's start with you. Next Insurance has been a leader in the direct-to-consumer small commercial space, but has also been very vocal about the broker playing a more limited role in the future of small commercial. How do you imagine the broker's role 5 years from now? And are you guys considering moving upstream to a larger risk when it comes to direct distribution?
Good question. As you know, the small commercial insurance market is about $140 billion a year in revenue. Half of that, roughly, comes from businesses with less than 10 employees. So there's plenty of room to play serving those small, really small businesses. And I would say that that's where we are focused at the moment. Those are the risks that lend themselves the best to automated decisioning. And on our platform, there's 0 referrals. So we get an application, we decision all of those applications in real time, and the applicant gets an approval, a quote, or a denial on the spot. We believe we're best equipped to do that for the less than 10 employee businesses. We dabble in the less than 20 employee, but I would say that hasn't been our focus to date. With regard to the limited role of the broker and agent, I would say we're learning, and we are encountering more and more small businesses that are looking for that advisor and that value the relationship that they have with their agent. And we're not the ones to tell them otherwise, right? So we are really now thinking about how do we provide value to the agent. And since we've diversified from our focus on distribution to now owning the product, the underwriting, the rating, the servicing, and the claims experience, we believe that we offer amazing value to the agent. We've started working with brokers and wholesalers and some carriers, and today about 20% of our premium actually comes through the retail channel. And what we deliver there is simple, tailored product, very competitive rating. We impose no fees. There's no policy fees, there's no cancellation fees, no COI fees, no financing charges. So you are able to offer to your customers a very competitively priced product that requires no paper applications, no waiting, servicing in many instances is self-service, unlimited free COIs and additional insureds, and we are there in control of the entire experience and at your service when your customer needs us. So I think we've shifted our focus away from distribution only, and we're really thinking of ourselves as a full-fledged insurance player and moving from being an MGA to an insurance carrier. We're licensed in 20 states today and working on more.
Thanks so much. All right, Phil, as an insurance veteran and longtime friend of the council, just wanted to ask why you decided to make the strategic to structure Corvus as an MGA, and second, why you chose to sell your product through the brokers channel instead of going MGA direct to consumer.
Yeah. I think a lot of insurtechs go to market in the way that Next has, by focusing on the smallest customer first, because in many ways they're underserved by the existing distribution system. And so there's a lot more opportunity. And then make decisions like Sofya was just describing, of maybe going up market. We took the approach of addressing perhaps a narrower market in terms of the product lines, but going to the small and mid-size market right away. And everybody has a different definition of what mid-size is. For us, the small market is up to 300 million in revenues, and mid-size is 300 million to 5 billion. So that probably just reflects where I've spent my career more than everybody else would have a definition of that. So for us, as anyone who relies on venture capital or investment from third parties, we have to find the most efficient use of capital. So going to market as an MGA means we don't have to fund our own balance sheet. We can have the strength and security of A15 paper and get to market much more quickly than we might if we took a longer period of time to become a full stack insurer right away. That's much more challenging.
Great, thanks. All right, Steve, when building AP Intego, you strategically flew under the radar with a partner-driven approach where small commercial can be purchased through your partner's brand, as you mentioned. Can you briefly describe why you chose this approach, and how has the partnership approach added a layer of trust when working with the consumer, the insured?
Sure. We definitely flew under the radar screen, largely because we were a byproduct of our partner's brand. And we felt it was the best policy acquisition kind of strategy, in that our cost to acquire a customer was our kind of marketing lead fee deal with our partner. So we only pay them for business that we write. We're not engaging in SEO strategies, pay-per-click strategies, or spending lots of money with Google and chasing, insurance as a key term on Google. We have leveraged the fact that our background as a software, my background is founding a software company, and my partner, we leveraged the fact that we built a transactional platform for small commercial that we're able to purpose and insert inside of our partner's software product. So we allow our partners to introduce the concept of buying an insurance product to the small business, and we serve as their fulfillment engine. And that provides us some value beyond a fixed customer acquisition strategy. It's the value of the customer experience that the small business has in transacting within one system that might provide them the general ledger, payroll. They're only dealing with one ecosystem to run their small business. We're getting data from our partner that allows us to pre-fill different fields in the transaction that simplifies the buying experience for them. And I call it the kind of the anti-adversely selected model. Our various loss ratios are under 30 with every carrier that we deal with, because our customers, small businesses, come to us completely vetted by our partner's own vetting process. We know that they pay taxes. We know that they're not criminals. We know that we have their payroll. We have data elements that help us understand our customer better, and ultimately that defines a better book of business that we're building versus acquire a customer over the web directly. So to answer your question, I guess it's a pretty long answer, but we love our model. It's proving very successful. We're seeing players in InsurTech pivot to us, and we're no longer under the radar screen.
Great, thanks. Jeff, Nationwide also recently announced a partnership with Amazon Alexa. I believe it's called the Echo Auto. And just wanted to ask kind of the process working with such a big tech company, and how you're offering new and innovative solutions to your current Nationwide customers.
Yeah, it's a great question. So my guess is that most folks in the room have some piece of this massive pie that's called Amazon. Whether you buy from them or you sell to them, or you have a part of their reinsurance stack, they're a massive company. And I think so Steve and the rest of the group really articulated how Nationwide's thinking about the future of meeting customers where they are. So over the past decade, insurance companies have spent tens, maybe hundreds of billions of dollars advertising, trying to get customers to come to them. And I think that customers are becoming accustomed, because of companies like Amazon and ecosystems where they can accomplish a lot in one space. They want companies to meet them where they are. They want companies to integrate into those spaces. And so we view Amazon as sort of the king of ecosystems, as one of the originators of an ecosystem, and that we want to figure out how can Nationwide integrate our solutions throughout the Amazon ecosystem in a way that's really easy for our customers to buy it. And a lot of that comes down to the same thing that Steve was mentioning around customer acquisition, that it's far more targeted. It's essentially a risk selection approach where you can find people with certain attributes that align with your underwriting characteristics. And if our technology can get there, which it is, we can do some really interesting things. And so with Amazon, we've launched a promotion where we are giving away 1 million Echo Auto devices to current members and new customers. And it's essentially Alexa in the car. And a lot of newer cars have Alexa built into it, but a lot of older ones do not. And essentially, it's a way to retrofit much of the existing fleet to give certain driver safety capabilities and convenience capabilities while they're driving. The whole process of working with Amazon has been really interesting because they are exactly who they say they are, and they're gonna get what they want, and they're gonna get what's best for their customers. But we have a lot of different things happening with Amazon that's really interesting. Probably the most exciting part for us, the biggest win for us in this Amazon partnership that we launched, is that we have an integrated quoting experience leveraging Nationwide's APIs, where you can pre-fill a portion of your auto insurance quote with your Amazon account information. And so that was a big win for us, and we're now looking at other places where we can replicate that within the ecosystem.
Great, thanks so much. So back to Sofya, and I think, Phil, you might have a comment on this as well, but I'd like to circle back to your comment about Next beginning to take on risk. I know you first started in Delaware, I believe, as a licensed carrier, and I just wanted to ask if you think more MGAs will kind of go in that route where they'll be begin to take risk, and was this always a vision of Next, or has it evolved as the company's evolved?
Yeah. It's definitely evolved for us. We started as a pure distribution play. That was the plan. But we saw so much opportunity to add value by using technology and analytics in the product development process itself that we've expanded our reach. I think the MGA versus carrier model is about capital. To some extent, it's about your business model and bottom line optimization. As you know, MGAs typically work with a fronting company. The fronting company doesn't work for free, right? Takes a piece of your margin. And ultimately, it's about your horizon, I think. If one is building a player to be sold off, let's say, in a few years, investment in becoming a carrier is a massive amount of work, requires a massive amount of capital, probably not the way to go. If one wants to be a key player in this industry over the next several decades and own a double-digit market share, I think carrier is the way to go. And we are here for the long term. And there are other companies that have taken this route. I think Metro Mile has gone through a similar evolution. So we believe it's the right investment for us to make.
Great. Anyone else have a comment on that?
I'll start. For Corvus, again, one of our core values, one of the most important things to us is building up data that will predict and prevent claims. So that starts for us with building our own proprietary cyber hack database, enriching that constantly, and then doing scans of IT security on thousands of organizations every week. So building up a library of information that we think makes us better underwriters, and better includes being more profitable underwriters. If we're right about that, and it takes, even in a short tail line like cyber, it takes a couple of years to have the evidence that you have, say, Steve's loss ratio. But if one is able to do that, then it becomes very tempting to look at other ways to capture the underwriting profit for your stakeholders. Now, that doesn't mean you have to become a full stack insurer. There are a lot of steps in between that we could have a whole panel on discussing some other time. But it's important to be focused on that, to be creating value through data. And that's possible with a modern data architecture, and the type of thinking that starts the company on that foundation.
Thanks so much. So
I'll chime in real quick on that. One interesting observation is that I've probably talked to 10 large adjacent industry companies in the past year who have stated their desire to become an MGA or an MGU, and they're not in insurance at all today. And that's because the economics that are available to them in distribution aren't quite enough, and because they want the control over the customer experience. And they believe that at deeper levels, so they don't want to get all the way into the carrier space because of the economics and the capital required, but becoming an MGA or an MGU gives them a level of control that they don't believe a standard market carrier is going to offer them. I believe we're going to continue to see a lot more of this sort of activity driven from the side from adjacent industry companies as well.
Yeah, I completely agree with you, Jeff. It's from my perspective, and what I believe is thematic. It's a theme in InsurTech in general and small commercial. I believe anybody who's doing it, they're doing it to control product definition, to deliver a better user experience, because the standard markets they're dealing with don't provide them the products in a simple, non-complex way, or in a technically sophisticated way to be able to deliver a better user experience. All of our partners are more sophisticated technically than anybody in this room, and they require a delightful buying experience. And there's nothing about a small commercial insurance product that is delightful.
thanks so much. And I think we have about 12 minutes left, so I'm going to circle back one more time, but encourage you again, feel free to post questions on Slido, and we'll try to spend the last 7 minutes or so addressing those. But back to Phil. So I'd like to touch on your specific product in a little bit more detail. You describe your product as a smart commercial insurance product built on data-driven underwriting. So you first started launching your smart cargo, and then you moved towards cyber. Can you elaborate on kind of what you're working on and where you're heading?
Thanks. Yeah, so cyber insurance, as I said in my intro comments, I think the industry, the property casualty industry, is understanding more and more as a peril rather than just as a product. And you see that with Lloyd's of London announcing that they now want cyber exclusions on every policy that doesn't cover cyber affirmatively. The recent AIG announcement suggesting they're going to move to the same place by the first of the year. So that all of this defined in a term called silent cyber that's really critically important to the P&C industry as a whole. So we're doubling down on that risk and trying to add affirmative cyber coverage to existing product lines. And this isn't a new idea. Anybody in the audience who's an insurance broker that's been selling insurance to tech companies has been selling a combination tech E&O and cyber policy for the last 10 years. But for some reason, that innovation stopped with that one area. Yet cyber risk is becoming a bigger and bigger part of our economy. Every business is doing something online and probably doing a lot more online this year and next year than they were last year. And so to be able to reflect that better, the combination of cyber risk and other conventional risks becomes critically important, I think, to serve the needs of customers. So we're focusing on that in a big way.
Thanks. And so Steve, AP and Intego might not necessarily be an insurtech. I mean, you have a software and you're forward thinking, but you also have 50 agents and 60 customer service reps. So how does AP Intego combine its front and back end technologies while also serving the role of traditional brokerage that values itself on customer service? And how is the customer's experience affected here?
So everything that we do is to support what we believe is an amazing customer journey to buy small commercial insurance. And if we can't present that, our partners will fire us. So we have to use technology in, as aggressively sophisticated and as aggressively as we can and as sophisticated a manner as we can, and to present as much of a, call it the Silicon Valley-based transactional experience that we can within the constraints of kind of the space we play in as an agent. We have 20 years of collective experience in this space. We understand the technical and political obstacles that challenge us relative to delivering an amazing agent-assisted or choice model to our partners. But at the end of the day, we combine that automated buying experience with the backstop of a traditional insurance agency with licensed agents that are able to pick up the phone and answer any questions a small business might have before they buy. And we're finding that 9 out of 10 times. So I think it's, at the end of the day, all we're trying to do is build an agency fulfillment engine that is highly efficient, and it supports our partner model in terms of converting as many small business leads that they send us. So it's at the end of the day, we're aligning an agency model, front and back office, with the fact that we believe more small businesses will want to buy their insurance from already a trusted supplier, our partner. And some would say that that's very similar. It's affinity-based insurance marketing 2.0. We're just using technology to do it, as opposed to what a carrier and Marsh might have been doing in 1975 with a mailer. We're doing it with technology into an ecosystem that's serving the small business.
Thanks so much. And back to you, Jeff. So I'd love to hear Nationwide's strategy around keeping up with some of the competitors that would define themselves as a true insurtech that might be a little bit more nimble and be able to make quicker decisions. How has Nationwide approached that and to stay ahead of the game, but while still, functioning as as big as your firm is?
Yeah, that's a great question. So from a personal standpoint, anytime I sit down with a large adjacent company, they say, hey, we're talking to 3 groups. We're talking to insurtechs who are nimble and fast. We're talking to brokers who offer breadth and choice. And we're talking to traditional carriers who offer great capital backing and brand strength and stability. And I believe that the answer is a combination of all 3 of those things. So Nationwide is obviously continuing to compete as a traditional insurance company and digitizing our products and our underlying services. But we are working through our venture capital team, for example, to make investments in a number of companies that are in this room who are insurtechs. We are partnering with insurtechs through a number of different areas of our business. And then we're also taking our best shot at building them. Many of you saw the announcement a couple weeks ago about Spire, Nationwide's digital auto insurance platform for self-reliant millennials. And so, we're really placing a range of bets in that space. And the good news about us as a mutual insurance company is that we can take a long view on these questions. And we do think and talk about them, and we do realize that they're a legitimate threat to our business. But we also realize that there's a lot of room for us to work together. And so, I think Next Insurance is a great example of an investment that we've made from our venture capital team.
Great, thanks so much. So, question for the group. So I would say, 3 years ago when we first attended the InsurTech Connect conference in Vegas, it was all about disruption. That was kind of the word of the conference, and it was an outside looking in, not many traditional market players. And I would say the conversation's changed dramatically since then. It's about partnerships, enablement, and this year is about implementation, moving beyond the technology and really making it about process. And technology's data's only as good as what you put in. So I'd like to hear your thoughts on kind of where it started in the personal line space. I do think we're starting to see meaningful change there. Do you think we'll see a true disruption in the small commercial and even upstream in the years to come?
I think we're seeing it right now. I think it's sitting on this stage right now that, yes, I believe that we will. I think it will look different than personal lines. I think the temptation is to want to say that it's going to follow the same pattern. I believe some of the things that have been talked about on stage here, the pattern for personal lines was that you had 2 companies that spent billions of dollars in advertising to drive the transformation. I don't think that that's possible in the small commercial space. And it's going to look a lot more like what's happening amongst the folks on the stage here.
Anyone else?
I think that's right. I think that small businesses are looking for better experiences. And with technology and analytics, those are becoming possible. So players are coming and offering those. And I think the transformation is happening. May not be as quick or as dramatic as what we've seen in personal lines, but I think it is going on. And I think all of us as players in the industry should think about, how do I offer my customers that better experience, better value, more tailored product, lower cost of ownership, right? That's ultimately what we're all aligned on. That's a shared incentive that we all have.
Yeah, I mean, the other thing I would say is that we shouldn't ignore the emerging risks that a lot of small businesses in the gig economy are stuck between commercial lines and personal lines, and that there's a lot of emerging risks that big tech companies are trying to solve through their own captives. So I also think that there are things happening outside of our traditional lines of business.
Great, thanks so much. Go ahead, Steve.
Yeah, I don't think there'll be the classic TechCrunch article about disruption that's going to happen to small commercial insurance. I think it's an overused term, and I think the InsurTech kind of hype of disrupting small commercial is way overblown. I think the traditional players will still be the leading players. Percentages may change a little bit, but small commercial can't be compared to what happened in personal lines. It's a very different, much more complex transaction. It's less commoditized like personal lines was for the product manufacturers, the carriers. There'll be some success, however you define direct, but there'll also be success with either with an intermediary or a startup or an InsurTech player, but there'll also be success with the carriers going direct. I mean, the small commercial landscape will be, I think, as disrupted by the incumbents as it will be by new players over time.
So I just, add the one word that I'm surprised nobody said so far, which is, millennials and the behaviors, or maybe did you reference that, Jeff? That this kind of change that happens very slowly, but then 10 years go by, and all of a sudden you have a whole cohort of buyers who are saying, why isn't there, or of course there is a digital experience, and I'm more comfortable there, and I want to try that first. And we all know that's happening, but these changes that take place day by day sometimes aren't as obvious.
Great. Yeah, I think someone may
Yeah, that was a funny question.
have been a little sarcastic, but asking if there's anything.
Yeah, about self-reliance. So I'm a senior millennial, and I think that millennials like to think that they're self-reliant, but they're not very self-aware. And so, who knows?
Thanks. So we have a couple questions coming up. I'm going to start with the last one. What competitor or company are each of you paying the most attention to? I think that's a great question.
We are looking at what Byberk is doing. We think that some of the efforts that they've put in to erase the lines between the traditional lines of business, right, and to say it's not about general liability versus professional liability versus workers' comp. It's about giving the business customer all of the coverage that they need given their business and their risks. So we've been watching with interest the introduction of the 3 product that I'm sure all of you are aware of and want to see how that goes. We think there are pros and cons there. But I think Byberk is worthy competition and probably the one we're watching the most.
Great. Anybody else?
I mean, we watch really the cybersecurity industry,
Right.
not surprisingly, right? The trends there and the threats and the defenses for that, which we think are an essential part of risk in the economy.
Right. So anyone else? I think there's a question for Steve, a couple, so I want to address some of those. Steve, how do you provide a delightful tech-enabled user experience for small businesses with exposures that fall outside of the standard market appetite? And we can go through the list, and then we'll probably finish up.
Yeah, I saw another question ahead of that. Would I license my technology?
Oh, yeah.
And I wouldn't. We've been asked to license our technology, but we're clearly focused on being the broker of record and generating revenues and profits just like any other agency. To the extent we'd license our technology to someone else, we're distracted. And I also did that for 15 years. I was the agency port founder. We sold front-end web-based software to carriers, P&C carriers. So I like being an agent more. I don't want to go back to being that. So we would not license our platform. And then the other question was delightful experience, and it sounded like in an E&S type transaction, which I think is impossible.
Fair. All right, let's end on one more broad one. When will underwriting use data mining to price small commercial business and simplify data collection from the prospect and/or agent? I'd imagine we're moving in that direction already, but
We do that today.
Right.
Our underwriting and pricing models are machine learning driven. As I mentioned, there's no human intervention. We say yes or no based on an analysis of the data provided by the customer, their behavior in our funnel, and how they're filling out the questions and providing the information, and a variety of third-party and social data that we're pulling in. So I think that day is here. There's absolutely room to continue to improve and optimize, but it's started.
Yeah,
And I think you see folks use first-party data from partners as well, where a lot of it can be indicators of and pre-fill with things that exist within partners that they work with today. But also third-party data is a great route, and Nationwide is already doing a lot of that just to reduce the number of questions that we need to ask.
You know, we just announced on Friday that we're using our proprietary database of cyber incidents and our machine learning tools to offer a differentiated limit of coverage for what is called social engineering or cyber crime, one of the certainly hot buttons in that vertical. And where we are, rather than doing what everybody else does, which is default and say, we'll give a certain amount of coverage for that critical area to every policy, we're looking at that individual underwriting level, and the machine is doing that underwriting for us.
absolutely. Steve, any comments on that?
Leveraging third-party data is part of our process, but first and foremost, it's leveraging our partners' data. And we have some really, I'd say we have some partners that are pretty sophisticated software providers to small businesses that cross over the general ledger, payroll, time and attendance, point of sale. We get bank information, we get payroll information, we get all kinds of targeted information that's super valuable, but is never great. So we have to augment it with a third-party kind of data source. And there isn't a silver bullet out there. That's why everyone is working on their own strategy, because there's not something off the shelf that you can buy that solves the kind of third-party data problem in small commercial.
Great, thanks so much. Well, I think we're running out of time. We're going to flip this to the next panel, which is on similar note, solutions for small business insurance distribution. And I want to introduce my colleague Cheryl Matochik, and she's going to moderate this panel, and we'll get started. So thank you so much for your time, and thank you to the panelists as well.
So we have till 9:20, so we're going to take a little bit of a different journey here and very connected to the first panel, but we're going to talk a little bit about small commercial strategies from a broker perspective. As you heard from the first panel, economics really drive success in small business, and you have to be super intentional and super efficient in how you think about dealing with your book of business. And the reason why we're doing this today is a lot of the CIAB broker members have, really worked on taking an authentic look at what they're writing in small accounts and then trying to link that now to a tech strategy as they figure out where they want to play in the digital value chain. And to the extent that you heard from the first panel, the shifting buying point for small business customers, going to more of a digital platform approach and a one-stop shopping experience, that really requires brokers to think about how they integrate and how they work with different partners. And that's a very different skill set than brokers have, really tackled in the past. So we thought we'd, sort of have a host of different companies over here who are tackling this in a different way and get some of their insights. And then what I'd really like to do is leave a good amount of time for questions. Again, Slido, throw your question in there. We'll get those. We'll get to those in a second. So I'm going to start with some self-introductions, but what I'd like you guys to do is introduce what type of company you are, and then little level set on how you define small commercial, small business in your organization. Everybody tends to define small business a little bit differently. I end up in a lot of conversations where we're talking about small business, and then I realize we're really talking about micro insurance. So, if we could go down the line with that, and we'll get into the strategy question afterwards. So why don't we start off with you, Dan?
Okay, great. Dan Kazin, CEO of Insurion. Just to answer your question very quickly, at Insurion, we're really a micro business. You're talking policies where the premiums are $10,000 or less. For those of you that don't know, Insurion is the largest digital agency that is focused solely on small commercial in the U.S. We've been doing this for about 8 years. We have sold over 550,000 policies. We get about 3 million visitors to our website each year. We'd be, in the top 60 brokers in the United States just selling small commercial. Importantly, with Insurion, as you mentioned, the thing that makes that work for a small business digital agency is technology. Right, the more you touch small commercial, the less profitable it is. So we have a proprietary technology that we use to run our agency. We also license that technology to other large and small distributors of small commercial insurance so that they can reap the same benefits that we do when they're selling that product, which is, again, as you all know, very difficult to do on a profitable basis.
Great, thank you. My name is Matt Miller. I'm the founder and CEO of Embroker. We're a digital commercial insurance broker and managing general agent. We work with small commercial companies anywhere from 0 to about 500 employees, so we also do the larger end of small commercial as well. And we've built a proprietary technology platform that streamlines a lot of the touch points that companies have as they become more service intensive. We also have started to build a whole suite of both standard and specialty lines and distribute them through our own platform.
Hi everybody, Ilya Bodner, Bold Penguin. It is funny to watch how small is different already from one to the other, and what I'm about to say is going to be different too. For us, small commercial is 2 to 99 employees. That's how we look at it, which tends to be policies that are under $15,000 in annual premium for the business, and typically tend to be over $1,000 in annual for the combined different coverages for that business. Bold Penguin decided not to go down the route of being a broker, not to go down the route of trying to build a new insurance company. Instead, we wanted to build an exchange that upgrades the entire industry. So what we do today is license our technology to the distribution channel, brokers, agents, insurtechs, to do the quoting and binding of small commercial, easier, smoother, simpler through the use of technology. And then on the other side, we work with carriers to help them first modernize or digitize their products, and then distribute them in a more digital fashion to the channel that they want to distribute it through.
Thank you. Jared?
My name is Jared Carrillo. I'm a principal of Smith Brothers Insurance, and I have a couple roles in the organization, and one is fortunate to lead small business. We are not nearly as interesting as the 3 people up here, sort of lumping through, figuring out how to really find margin in a section of the business that's tough. We define small commercial as accounts that generate $5,000 or less of commission income into the agency. And we find it sort of interesting as these guys are figuring out through technology about how to integrate with the carriers that continue to broaden their definition of small commercial. Liberty's up to really be like $35,000 revenue accounts as they're small. So it's been interesting for us to how to align up behind the carriers. And really what our call to action is to get them to align behind ours.
Yeah, thanks. We'll go down the line on this one as well. As I mentioned before, really economics drives success in small business, and so you have to have a very clearly articulated marketing plan and how you're going after the small commercial space. Could you guys each give us like 90 seconds kind of on your strategy and what your desired outcome is in the sweet spot of where you're going after the small commercial market or enabling brokers to do so?
Yeah, sure. And one thing Ilya said, which is very important, and our platform does this as well, is being able to have the small business owner come in, quickly answer, give you whatever data is necessary to get a quote back from the carrier, and have that be done very quickly, seamlessly, and then be integrated with as many carriers as possible so that the consumer has choice there. So we feel that that's very important. And interestingly enough, in answer to Jared's answer there, because we're integrated with all of the major national carriers, our definition actually of small business is whatever their definition is, right? The integration takes care of that itself. It just so happens that in our business, most of the people that come in are, 1 to 10 employee companies that are really in the micro space.
Yeah, I think in our case we've seen that in terms of the economics of small commercial, it's really the after binding that creates a lot of the service cost and can create unprofitable relationships. We started with that knowledge of trying to automate a lot of the touch points that brokers generally have, but that they don't provide a great service to small commercial because it's not worth their time. So I think we probably reached the point where I think we have the most advanced platform in the industry for things that are outside just quote and bind. So policy analysis, endorsements, certificates, renewals, payments. We've automated all of those touch points, and we have an NPS score of around 70 from all of our customers combined. So I think that's been the core to our strategy, is just building a really good technology product and then finding ways to distribute that where we can provide an excellent experience to the end buyer, not only when they buy insurance, but throughout the entire life cycle that they have with us as a customer.
So the question was the economics around small business policies. We sort of see it as two different sides. One was what Matt mentioned, the servicing and after the buying. The other one is the acquisition cost. We at Bold Penguin focused pretty obsessively on the acquisition cost side of the house. To date, we've processed now a little over 1 million small businesses, which is the way we define 2% or 4% of the market, since there's about 25 million businesses, 99 employees or less. And what we see is that because of specialization, because of niches, and because of a very thoughtful approach that a lot of our partners have, no one can do it all. And so you almost need to have partnerships in order to offset the economic cost of acquisitions. And that's where our exchange obviously strives in. So we see two different types of customers. Those that are very thoughtful, like AP Intego is in the room, very methodical, very calculated about their acquisition costs. And then you got, the crazies that swerve all over every line and try to get as many customers and make reckless decisions and sort of realize that sooner or later. Regardless of the scenarios, the acquisition cost does vary pretty dramatically between, even within small, general liability, workers' comp, different types of coverage. And those that are very thoughtful about it are the ones that are succeeding.
Yeah, so the way we approached it is we took our small commercial book and segmented it. And no real divine sort of touch point, but it's just taking a gut instinct on what was driving a lot of our pain points internally. And so we took it as a standpoint of saying our teams felt generally overwhelmed, right? They didn't know how to get ahead of their day. They didn't know how to pick up with the pace. They didn't know how to prioritize one client over another. And so we simply just went through and segmented our business by revenue line. And then sort of looked at the profile of those clients, the distribution of client versus revenue, and that gave us some peace, I should say. So just to give you a little bit of ours, we look at our segments. Our smallest segment, we segment into $500 of commission income and below. Crass titling, but it's our C-band. So we are working to partner with our carrier outsourced service centers to help support that. That represents almost 75% of our client count, only about 15% of our revenue. Yet it's the noisiest class of our business, the people that are constantly calling with cancellation non-pays, or they misplace their ID cards, or whatever it might be, versus the higher end sophisticated clients like that were being underserved because we weren't being able to be proactive because we were reacting to our C-band clients. And so that has started to create some peace inside of our organization, and then using carriers to basically line up and behind that can support the different varying bands.
Gotcha. Yep. Thanks, Jared. Well, I can't pass this up. There's a question from the audience, Ilya. Can you give us an example of one of the crazies that you refer to?
Do I have to give them out by name? Or just like generally speaking about
Generally speaking.
InsurTechs, I put them in the crazies. I always tell that my peers in the industry have their hair slicked back, the top down, and they're sort of just like swerving all over the lanes, right? Next has it figured out. They did, Sofya admitted with the fact that they started as distribution play, then, I can almost imagine being in the room there. They're like, wow, these carrier integrations suck. So let's try to fix that, right? And they did. And then they're like, wow, this claims handling experience really is terrible by this third-party administrator. Let's try to take that in-house, et cetera. So those are the more thoughtful and the ones that are figured out. But there's still a lot of insurtechs out there that just like pour money away on Google and Facebook because that's like the first thing that everyone thinks that they have the brilliant idea on. And drive up the cost for everybody. Unlike Dan and Insurance, we don't compete with our customers on the open market. We do actually try to make sure that the cost of acquisition is low, but the crazies are the ones that are making the decisions, mostly insurtechs. There are some insurance companies that flare up and say, hey, I want to go direct, and I want to grow my book to 100 million because that's what sounds cool by 2020. And they obviously are driving up the cost too, and then they realize they can't sustain and pull out as well. Love to give them out by name, but I don't think that's appropriate.
We'll get to some of these other questions in a minute, but I did want to pick up a thread here about, as I've been talking to a lot of brokers and they're evaluating different digital platforms, small commercial comparative rating systems and whatnot. Looking at sort of the chicken or the egg issue a little bit, obviously brokers want to see the carriers they're doing business with on these platforms. There's, a lot of places carriers can hook into, and so there's sometimes resistance there. Can you comment a little bit about sort of how you've tackled that issue, Dan, and you guys can chime in as well. I think that would be an important sort of note to get a sense of where that is and what you felt on how you addressed that.
Sure. Listen, we've been in the digital agency and small business for over 8 years. It's very important that you have on your platform all of the carriers you need, right? Because otherwise, you're distributing their product. And so we have the luxury, because we've been doing it for so long, to actually have integrations with all of the carriers, which we believe is an important differentiator for us. We have 50 plus carriers, all of the major nationals, and it's just that we feel is really key. It's a good question because that at the end of the day, if you have a platform, but it doesn't have the carriers that you do a lot of business with, it's not really worth that much.
Anybody else on that one?
Yeah, I'd comment on that too. This one I'm still scratching my head on. I know a couple of people in this room, several of you, I meet with you individually, and if you're on the broker side, you're like, of course I want to integrate with carriers. Those are my top ones. And then separately, we meet with carriers, and we're like, hey, let's do an integration. And privately in one-on-one meetings, you're like, of course we want to integrate and offer our product in a more streamlined way where there's less FTE cost to handle to our distribution channel. But then once you get in formal meetings, there's this like weird dance, and the integrations sometimes do happen, sometimes don't. And I'm not sure why, because everyone wants it separately, but it's not always clicking. Like Dan said, though, it is important for both. It's kind of like going on Expedia and Delta not being there or something like that. It's kind of a useless tool, right, at that point, because you might as well just go to Delta separately. But it is an interesting one where I'm not sure why it's not clicking the way it should be.
I would add that I think it is changing a little bit. I'm sometimes surprised by how many people we get reaching out to us asking if we'd like to do an integration, and it's great. But at the same time, there's a lot of them. I think it tends to speak towards the amount of digital products coming out to the market right now. And I think there's relatively few players that are in a state where they can actually integrate and distribute directly. And so I think for the amount of time and money that's being spent to digitize insurance, there still feels to me like a dearth of people who can actually use that technology and create value to the end customer.
That is a really good point. Definition of integration needs to have an asterisk to it. Just because someone can screen scrape your website shouldn't be counted as integration, but some do. True online integration into the production servers of carriers or agents for that matter is the one we should be really talking about, but it is sort of this big bucket.
I feel like the black swan because this is really interesting, and I'm going to go about kind of the old-fashioned way, which is, I think we net have far too many carriers, and whether that's like an indeliberate approach to how we service our partnerships, or pick up a new company through an acquisition, and we're not quite sure how to either decentralize them or do a book roll away from them. But when you talk about the micro section, like again we describe as $500 of commission income and below, if we can't do that with 4, maybe 5 markets, I think we've got a fundamental misunderstanding of the product that we're trying to sell. The way I look at it is that our people that are looking to buy our products are buying plane tickets, and I don't think they really care the brand of the plane they're getting into. I think they need to know about the class of seat that they're buying. Are they going into the plane to buy a first class ticket, business class, economy plus? And I think a lot of that has to do with their orientation in the market. And so a little bit of, I'm not really quite sure how I feel about it yet, but I still resist this idea that what we're doing is a commodity play, that it's all the same. And so then the price becomes I think the definition of commodity is when all else things are the same and the only thing that's different is the price you pay for it. That's a commodity. And that's not what we have. As everybody in this room knows, you can skin a traveler's product 14,000 different ways. And I think it has as much to do with the expertise of the person sitting at the desk and the sophistication of the person asking for the product, as it has to do with whether or not that any given minute of the day, what carrier is more relevant than the other. Every company that we do small business with has 600 classes of eligible business on a BOP, and will take limits that are really, in our business, in our agency, considered to be large exposures. So I think when I think about our segmentation from our C bands up to our A bands, is sort of like an inverted triangle, right? We give a limited carrier selection at the bottom, and sort of open the scale and scope of who we're giving it to and who we're selling it to, up at the top of that upside down triangle.
Yeah, I mean, I'm going to pick up a thread here and redirect back to you, Jared. Oftentimes, in our industry, I think we think small premiums, small service, and, what are you seeing in relation to super effective, super efficient servicing constructs, relationships, as you go about trying to make this as the best economic play that you can?
Yeah, so Cheryl and I talked on the phone, so everybody knows this wasn't completely organic. We could kind of tease each other a little bit, but I think first you have to answer what kind of agency you want to be. Do you want to be a Main Street agency? Do you want to be more of a tech play? Do you expect to have hyper density locations, or do you like having a 5-person shop on Main Street? And then I think part of that also gets into looking at your book of business and deciding, who you want to be to those buyers. I think when we think about partnership, we're taking that C-band business as I described, and we're trying to lay as much of that work off to the carrier service centers and the ones that do it the best for us, and then retaining as much work as we possibly can for those better buyers. I mean, in our world, I like to think of my own business before I became a partner at Smith Brothers. I mean, if you took my E&O out, when have you included my E&O? I don't know if I generated $5,000 of commission income totally, and I was, 25 people and, driving myself crazy every day. And I thought I had a pretty sophisticated need for my buying needs. So I try to think about myself, how I would want to be treated as a small business, and what my expectations of my broker would be. And so I think the difference is with us, where we're really struggling, is that expectations of the market today, because of the Amazons of the world, is that it's the things that shouldn't be painful that are, and I don't know how to fix that yet. So we're really relying on our carriers to do that for us, because at the end of the day, if we have 35 carriers, are we the best navigator of that billing system? We probably should be. We're expected to be, but we're not. So we're going to give that back to the company so they can handle that for us and don't create any disruption at the buyer level.
What about you, Matt? How are you approaching the servicing aspect?
Well, first I was thinking I should get you guys to broker my E&O, because we definitely have more than $5,000 in commission on that. But yeah, maybe deserved. No. I think
you lost control too, just in case you want to talk about that later.
Yeah, we can discuss after.
Great, that's awesome.
Probably a need. No, I think for us, it's definitely, we've taken a different approach in that we actually started using carrier service centers and went away from it. And I think the reason was, it was really, I think some of them do a fantastic job, and I've toured them and I've seen their operations. And I think at the same time, for our buyers, and we think a lot about our buyers, it was almost always painful for them for a variety of reasons. No one likes getting a check in the mail from the Hartford. It's just not fun. And they would never find it, they would never pay it, it'd be canceled, they would call us, they would have a policy with one carrier and then with another one, and the service center couldn't service it. And so that was actually why we ended up spending a lot of time and energy on putting in place a foundation that would automate a lot of those touch points. And so we track really closely, how many certificates are done without touching anyone, how many bills and payments, even credit refunds are done with nobody touching it. And each quarter we try to see it tick up a decent amount. Ultimately, I think that's, our buyers are tech-forward buyers that are used to using software in other parts of their business, which is great for us because they try things that are totally new and they'll tell us whether they're working or not, and oftentimes they don't. But we've been at it now for 4 years, basically trying to improve each aspect of those touch points so that we get to the point where the software can really, really take out a lot of the lower value-added work that brokers tend to have to do, and that our brokers then get to act as more strategic advisors and talk to clients about risk and not have to service the smaller stuff all the time. They still do sometimes, so it's not complete yet, but I think we've been making progress on that front.
Thanks, Matt. I'm going to skip around and address one of the questions on the board here. What has been the biggest surprise or most daunting task when building out product or your company? Dan, you want to go first?
I'm sure. Sorry. As Ilya pointed out, and a lot of people do fall into this trap, you got to remember on digital businesses, customer acquisition is not only can it be expensive if you're not careful about it, but it can be really, really hard. I think there's a kind of a misconception that because someone's a technology company, everything comes more cheaply and very cost effective. And it does once you get the technology rolling. But from a customer acquisition experience, you have to be on top of that all the time with a lot of data, understanding what it's costing versus what you're getting out of the customers. Partnerships are an incredible way to acquire customers. And I watched the panel before this as well, and a lot of people are trying to build a better mousetrap by becoming MGAs, or carriers and things like that. At the end of the day, though, customer acquisition is key. And that, I think, is a challenge for everybody. And, I think as far as the crazies that Ilya pointed out, I think all you have to do is look at somebody that has just raised a lot of money. They're going to spend a lot of that money on customer acquisition and then find out that they were doing it in an unprofitable way.
Anybody else want to comment on that one?
Yeah, I think from my end, one thing that has been an unexpected surprise, I guess, is just the how much there is to build actually from a technological perspective. It's actually a pretty complex product when you think about not only just the integrations with carriers, but starting to build a platform that handles a lot of commercial insurance. It's a big thing to bite off of. And I think that's something that sometimes I'm like, wow, there's a lot of easier ways to make money. I pay for software for my own company that is a lot simpler, and I pay a lot more for it. And I think that's one of the challenging things about the small commercial model is that at a small scale, it doesn't really work or make sense in terms of the investment required. But I think, that's one of the things the panel is about, is that it will be solved because it's not a technological problem in and of itself. It's just requires a lot of work and effort to actually get to a product experience that really does provide a full solution for clients.
Didn't mean to jump ahead. We've gone on a vertical approach, so we have a couple specialty operations in small commercial, lawyers professional, jewelers block, trucking, and then emergency services like ambulance corps and volunteer fire departments, and find that by becoming the trusted advisor on the things that concern them the most. So think about like a lawyer's professional policy. We get a lot of runoff business from that sort of feeds the other pieces of their small business group. So becoming known in these really tight-knit industry segments. I mean, firefighters are crazy people, and they hang out a lot together, and they talk often. And so if we're good at it, I mean, it's I guess the tale of two cities, right? It's great for us right now. It could be awful if we start to fall down on it, but right now it's helping us backfill all the other cross-lead segments into our business.
So for us, our product is the platform, not an insurance product. I'd say the most daunting task for us, insurance, unfortunately, it's very sad, but the average insurance executive is a 56-year-old white male that spent his whole life in insurance. So to talk to that guy and to tell him that Windows 93 is not the coolest thing ever anymore, and that we're not building a comparative rater, we're not dealing with lead generation, we're trying to digitize and not build a robo-advisor, and it's not some young kid telling him how business should be done, but rather we've been in it ourselves, been agents, and are trying to build something that enables the distribution to happen smoother, has been very daunting, to say the least. Have a lot of war stories, happy to tell you about it afterwards. And then on the positive, the nice surprise, on the other hand, has been what Matt did say. Bull Penguin wouldn't be alive or around 5 years ago. There has been this kind of shift, or we're over the hump of where enough critical mass big names have invested into technology and realized that it is a true investment. You can't just throw more bodies at it or spreadsheet your way or workflow your way out of it anymore. And there's enough of those that are sort of pushing the others to come along with them. And there's enough proof points to where we are able to do things such as API integrations. We are able to digitize or offer straight-through processing from online to offline. And again, that couldn't be, I was very pleasantly surprised that over the last couple of years, it's actually moved to the other side.
Dan, we've got a question for you here. Given the great front-end experience you provide consumers, do you see your retention numbers reflect that experience?
Yeah, our retention numbers are really excellent in small. And we do a combination, actually, of what Matt and Jared were saying. We're really we would love to throw stuff into service centers because there's an obvious cost savings there. But we're very careful to make sure the customer experience is not terrible, as Matt explained. So we do a fair amount of that so that, again, as Matt mentioned, our account managers and service people can really be consultative on the renewal end. And so, I actually don't come from the insurance industry. I've been very pleasantly surprised, overwhelmed almost, about how good our retention rates are.
Thanks. One question that, if we were here a couple of years ago, there was a lot of folks, in this battle to use third-party data to get down to the smallest amount of questions, and really be able to say, hey, we provide an immediate bindable quote versus an indicative quote. A lot of people were saying they could do that, but it was a bit of smoke and mirrors. How have you seen that evolution play out? Are we really at a place now where a lot of players are able to provide that immediate bindable quote, or are we still sort of in the smoke and mirrors stage of that? What are your views on that?
I think the last panel answered it really well, that each of them individually is working on their own way of displaying information and being able to offer a quote right away, because third-party data is incomplete, often useless, really, in that case. I wouldn't say that I see a lot of companies being able to do it. It's still a lot of smoke and mirrors, where you fill out questions, and then you have to refill them out again, and then refill out again. But there's enough of big key players that have finally invested into restructuring the way that they ask questions in order to originate a price.
We experimented with this with a number of business classes earlier this year and late last year. And, people always say, well, the holy grail is for somebody to be able to go online and go all the way through to bind without talking to anybody. And what we found was, well, first of all, and the other panel touched on this, a lot of the carriers are not ready for that, right? They still have some of their underwriting, a lot of their underwriting rules and requirements. So very few classes could you even do that today unless you were your own carrier or MGA. The other thing we found, though, was, and the gentleman from Liberty touched on this, is even in the classes that you can go through and go straight to bind, which is very few, at least in our experiment, most of the people do want to talk to somebody, right? It's small commercial insurance. There's a complexity to it. In our case, because we're dealing with micro, a lot of the customers probably didn't even know they needed insurance until they got a client, and the client said, what type of insurance do you have? They went online and got it. So they do want to talk to somebody at some point in the process, at least today. I'm sure that's evolving.
Yeah, I do think it's changing, though. I mean, one reason why we started our MGA was the exact difficulty of actually getting, especially specialty products. So, we did launch a directors and officers product that you can buy in 3 minutes with 5 questions, and we're about to launch one for legal professional liability as well, focusing on classes where the policy dollars are small, and there's just no solutions out into the market in terms of being able to actually, buy specialty coverage online. And that's been actually pretty successful. So I think there's definitely demand for it, and there's an opportunity for insurtechs to step into the space and actually build products that actually do go through. But it's still, there's some way to go in terms of the entire breadth of products.
I'm going to cover the two other questions on the board. Jared, maybe you can speak to this one. Can small business brokers qualify insurance products by bronze, silver, gold, or 1 to 5 star for coverage?
Yeah, so I think the question's referring to the actual carrier that's providing the product to the buyer. And I think the answer is yes. What we still find is that, and I'm sure everybody in here would agree, that when you have a visiting from a marketing rep, which is I think one of the most still tired, the last vestiges of an old world, that it's going to move us to all of a sudden start selling with them again. They still have their lanes that they're very good at. And so internally, reputationally, like we know that Hanover and National Grange Mutual are like sort of our go-to for contractors. Not always the most cost efficient, but definitely have products that are built because they understand the line of business. So I think you can. We do tier our carriers as well that back up, and we try to align A-band clients with A-band carriers. And for us, it goes deeper than just the products. We line it behind the claim service, responsiveness for underwriting, compensation, brand value, like how penetrated are they in the market? Are we selling something unique, or are we tripping over other agencies that sell the same thing? So, but the answer is yes, I definitely think you do. I do think it's easier in personal lines. I think it's a much different. I mean, the problem with small commercial is that a minimum premium BOP could be a beautician or it could be a contractor, and those are vastly different exposures, yet generating the same amount of revenue, and the service allocation costs are going to be different. Where in personal lines, you can get big fancy houses, you can have simple houses, but at the end of the day, it's just houses and cars and umbrella products. It's a little bit more vanilla bean. So the products can be a little bit more easy to delineate. I would encourage the group with the feedback that I have here too, is that I hear a lot of our carrier trading partners talking about the cost of service, right? That came up in terms of like how do you do it efficiently? Why do they push us to go to the portal to process an auto change? Is because it costs them $220 every time we send a request for an auto change in through an underwriting desk. And so the way we do it is very simple about pulling back the average cost to take a phone call and the process of bill pay based on the average cost of my labor, the average time to service the type of request that comes in. So I think when you think about the value of the product, it's not just the piece of paper, the coverages that go out, it's how the carrier helps back into your organization, or how they help you integrate with their service center to make the service seamless and joyful, and then the product's clearly understood.
Thanks. Okay, one last question, and then we got to wrap up. What is, rapid fire, guys, what is your greatest value add to your core customers? Dan, let's start with you.
Fast customer experience on the agency side, and integration with all of the major national carriers on the licensing side.
I'd say making it easier for businesses to get the right coverage.
Being able to license our technology to write small commercial profitably.
Compressing all the various different services into one point of contact in the agency.
All right, guys. Well, thank you so much. We're going to be sticking around. If you have some more questions, we'll be hanging out here. Appreciate your participation this morning. We hope you have a wonderful day at the Broadmoor and a great meeting day. Thank you all.